This content is for educational purposes only and does not constitute financial advice. Always do your own research before making investment decisions. Welcome to the parallel economy. Have you ever stopped to wonder where money actually comes from? We use it every day, but its origin story is more complex and more magic than you might think. And when you compare the traditional banking system to the world of cryptocurrency, the differences become even more fascinating. Today, we're diving deep into a fundamental question. How do banks create money, and why can't crypto do the same? Get ready, because what you're about to learn will change the way you see your wallet, your bank account, and the entire global economy. Let's start with a simple, everyday action. You deposit $100 into your bank account. Now, you might picture that $100 bill being tucked away safely in a vault with your name on it, waiting for you to come back. But that's not what happens at all. In reality, your bank sees your deposit as a resource. It's legally required to keep a small portion of it on hand. This is called the reserve requirement. Let's say the requirement is 10%. That means the bank holds on to just $10 of your money. The other $90, it doesn't just sit there. The bank immediately loans it out to someone else, to someone who wants to buy a car, start a business, or renovate their home. And here's where the real magic happens. When that loan is issued, the borrower now has $90 they didn't have before. They deposit that $90 into their own bank account. Suddenly, what started as your original $100 has become your $100 deposit plus a new $90 deposit. The money supply just expanded. This process is called fractional reserve banking, and it's the engine of the modern economy. It's a system where new money is literally created from debt. When a bank gives out a loan, it's not lending out someone else's existing money. It's creating new digital money on its balance sheet, backed by the promise that the loan will be repaid. Think about it. The money you have in your bank account is mostly just a digital entry, an IOU from the bank. The actual physical cash to cover all deposits doesn't exist. This cycle doesn't stop there. It snowballs. Remember that new $90 deposit created from the first loan. The second bank takes that $90, keeps 10% $9 in reserve, and loans out the remaining $81. The person who receives that $81 loan then deposits it into their bank. And just like that, another $81 in new money is created. So, what holds this whole system together? A single crucial ingredient: trust. We trust that the bank will give us our money when we ask for it. We trust that borrowers will repay their loans. And the system works as long as that trust remains intact. But what happens when it breaks? What if a rumor spreads that a bank is in trouble and everyone rushes to withdraw their money at the same time? This is a bank run. Since the bank has loaned out most of its deposits, it doesn't have enough cash on hand to pay everyone. The illusion of money shatters, and the bank collapses. This is the inherent fragility of a debt-based system. To prevent this, governments created central banks like the Federal Reserve in the United States. Their job is to act as a lender of last resort, providing emergency liquidity to banks during a crisis to prevent the entire system from unraveling. They can print more money to backstop the banks. But this power to create money also gives them immense control over the economy, influencing inflation, interest rates, and the very value of our money. Now, let's pivot to the world of cryptocurrency. This is where the rules of the game change completely. Crypto, particularly Bitcoin, was designed as a direct response to the perceived flaws of the traditional financial system. It doesn't create money through debt or lending. Instead, its creation process is built on a foundation of mathematics and code. Take Bitcoin, for example. Its total supply is hard-capped at 21 million coins. Period. No more will ever be created. This is written into its core protocol, and it cannot be changed by any central authority, government, or CEO. There is no Federal Reserve for Bitcoin that can decide to print more to bail out an institution or stimulate the economy. So, if it's not created by loans, where do new Bitcoins come from? They enter circulation through a process called mining. This isn't digging in the ground. It's a computational process. Powerful computers around the world compete to solve complex mathematical puzzles. The first one to solve the puzzle gets to validate a new block of transactions and add it to the blockchain, which is the public distributed ledger of all Bitcoin transactions, as a reward for their work for securing the network and validating transactions. The successful miner is awarded a certain amount of newly created Bitcoin. This process is transparent, predictable, and follows a predetermined schedule. The reward amount is cut in half approximately every 4 years in an event known as the halving. This means the rate at which new Bitcoins are created slows down over time, making the currency increasingly scarce. The supply is governed by an algorithm, not by a political committee. This fundamental difference leads to two systems with entirely different characteristics and risks. The traditional banking system is designed to expand. It creates money through credit to fuel economic activity. Its strength is its elasticity, its ability to grow the money supply to meet the demands of the economy. Its weakness is its reliance on trust and its vulnerability to inflation and debt crises. You are trusting in the policies of central bankers and the stability of financial institutions. Crypto, on the other hand, is designed to be finite and deflationary. Its strength is its scarcity and its resistance to censorship or manipulation. It's a system where you don't have to trust people. You trust in verifiable code and mathematics. Its weakness is its volatility and the fact that its value is not yet as stable or widely accepted as traditional currency. One system is built on credit creation. The other is built on digital scarcity. One is an inflatable raft, able to expand and contract. The other is a solid gold barret, can't be stretched, only divided. So, we now find ourselves at a fascinating crossroads in financial history. We have two systems operating in parallel. One is the traditional government-backed system of infinite debt-based money. The other is a new decentralized system of finite, algorithmically secured assets. One is governed by policy, the other by protocol. Understanding how both of these systems work their strengths, their weaknesses, and how they interact is no longer just an academic exercise. It is essential for anyone looking to navigate the future of money, investment, and wealth. The world is changing, and the very definition of money is being redefined before our eyes. The principles of value, trust, and scarcity remain the same, but they are now running on entirely new rails. Thank you for joining us on this journey into the heart of money creation. If you found this explanation helpful and want to continue exploring how traditional finance and crypto are shaping our world, make sure to hit that subscribe button and give this video a like. We have so much more to uncover. This is the parallel economy. We'll see you in the next one.